So this is values under different statutes. So you may be all knowing there are normally, if at all you go with a value is again you need to distinguish between value, cost, and price. So value is what you fetch in the market by going for if you go for a selling purpose. So the value may be market value. It may be derived by different approaches. The value may be derived by income, cost, and a market approach. So what is this value under different statutes? So there are different requirements from different statutes and how the value has to be derived. So that is what this topic, and we wanted to go ahead with this topic. So if at all under different statutes, like if at all you take this income tax. So earlier, if you all remember, there was a Wealth Tax Act. Under the Wealth Tax Act, the values has to be derived. They say that's the market value, but market value under wealth tax was under certain way of. It's not a deriving; it's only like a calculation. So normally, if at all, if you see the definition of or the scientific way of valuation, value means it's not both a science and art. So if at all it is a pure derivation, like it was in the Wealth Tax Act under Rule 8, it was earlier that they used to do just a calculation sort of thing. So, but they used to term that as also as a fair market value. So, but now that that wealth tax is no more there and it's abolished, and so the assessment under wealth tax is no more in place. So now the more of a valuation for income tax is being taken by the department or for the purpose of uh, giving capital gains valuation or cost of construction valuation. So there also they call it this as a market value. So if you take the capital gains valuation, the as per the capital gains, here I think we will be more stressing more about the mobile and the immobile asset valuation. Maybe this the group I think they need to appreciate, because we are mostly into land and building and plant and machinery value. So we derive more and we discuss more about this mobile and immobile valuation. So, if in this capital gain valuation, normally the valuation is done as per the market value. So, the market value of the asset as on 1/4/2001 is what the department wants, and that is how the value is assessed. So, the market value for the land as on the 2004 one, and the market value as on 2001 for the building has to be assessed, and that has to be given it to the department for filing for a capital gain purpose. So for a cost of construction, for income tax purpose, the cost of construction is also another area where the departments or the client wants the valuation. The valuation will be for the how much is the cost incurred by the client for building up the asset. So that is also they term it as a market value. See how much is the, in fact, by a definition, it should be called as a cost. The cost incurred by the assessee. In this case, how much the assessee has incurred to build up the asset. That's called the cost incurred, and that also the department the definition as per the income tax is called the market value of the asset. So that is how the capital gains and the cost of construction. So here during uh, the estimation under the cost of construction, a lot of parameters has to be considered. So be it the different methods of valuations are there, be it the plinth area method or the detailed estimation method, they call it. So you may be all knowing as a chartered accountant, when your client has incurred certain expenditure for building up an asset, so you may be aware how much that asset has been the expenses, the uh, to build up the asset is going into forming an asset. That is what we have to reflect, and that has to be correlated with the books of accounts what the assessee is maintaining. So here we normally, I think we have recently taken up a big hospital of more than 200 crores hospital, which has been come up. So for that, we have done this similar cost of construction, which has to be given it for the income tax department. So there, in fact, we have to do in detailed estimation for right from the construction stage to the completion stage. So this may be spelled out into different years. So yearly you have to give the estimations which has been incurred year wise and the stage wise. So that will be a big challenge if at all you don't have a proper documentation, or if you don't have a proper planning plans in the sense, right? So because this is done post mortem, like the asset is already been now done, and now after completing the asset, now if at all chartered accountant wants it, you need to put this for putting before the department. You need to file the report before the department. So, in fact, I have come across many such cases. Once the report is given, again the valuation cell of the income tax, they come out with uh, uh, they come out and they challenge the report. So that is another important area where the valuer and the chartered accountant has to be very vigilant enough to see that we justify the report what we give. So this is another niche area where not many professionals are taking up, but I think we have, in fact, I personally attended a lot of cases before the income tax ITOs and tribunals to give and justify the reports for bigger clients, because normally the bigger the clients, the more intricacies will be there. So that is a challenge which I think we are proud to say that we have undertaken, and we have in fact we could justify and we could solve the cases of the clients. So going forward, then next, see the valuation now for mostly for the banks. If at all you are also as a chartered accountant, you may be knowing that the banks also will be requiring this valuation. Valuation will be for the bank. So they require for the secured lending purpose. For secured lending purpose, they will require the valuation as a market value or the fair market value. Here there is a slight difference between what they are expecting. Uh, the IBA, here the IBA is Indian Bank Association. The Indian Bank Association has come out with the guidance notes or the guidelines for all the valuers. See, because they are the now the body, all the banks are under the IBA, and now they have come out with the guidelines for what is the method of valuation, what how you have to prepare a report, what is the mode of the appointment, how you have to appoint, how you have to do that, all that regulating for all that banks, for all the third party individuals. They call it third party individuals, like all the valuers, advocates, and the chartered accountants who do the third party assessment for the banks. They are all being regulated by this IBA. So they have come out with the paper, and in that they have notified what are the definitions which the bank expects in the report. So this is again a market value. Market value is an, if at all you see, this is a normal definition like the international valuation standard, which says that it is between the willing buyer and the willing seller and an arm's length transaction. So this is all the normal definition is what they have also adopted, and they have taken it into what they require. Again, they want, apart from this market value, the banks expects to have a liquidation value. In that liquidation value, they want to have orderly liquidation and forced liquidation. So that is called, as per them, it's called the realizable value and the distress value. Here, the difference between the orderly liquidation is what you will have a time for liquidating it. So you will have a sufficient time. You will be given, because the once the asset become an NPA, so they will give a proper notification in the paper, and give a time for the client to come forward. If at all they are not come, then they will go for the further course of action like auction and all that. So when the time is there, that is called an orderly liquidation. Orderly liquidation, and as per them, it's called the realizable value. The bank expects all these three: the realizable and the distress. Distress is the one where they don't have a time to sell the asset. It is only that you need to immediately liquidate the asset at a very less time, and you that is where the difference between the realizable and the distress is, there is no time for you to liquidate the property. So it will be on immediate priority to liquidate it. So normally what happens, you all know, when the property has to be liquidated on an immediate basis, this will be the least value of all the three: the market and the realizable and the distress value will be the least, and we need to give a reason for justification for how we have arrived at this distress value. So that is well the expected by the banks and the financial. So that will be the part of the report. So as per the banking parlance, they require all these three values. But when you go for surface evaluation, the surface evaluation will be the upset price, or the price at which they want to sell the asset. So there also the bank will be expecting at least the least of the three. If at all you see the market value, the realizable and the distress, so they want to they want to realize the least what they can realize out of the property. So there will be also the distress value. So that will be the start point for them to start the auction, below which they don't want to sell the asset. So this will be the value at which they will go for the auction, the start of the auction. So I think here there will be a certain sort of differences actually will be arising. Why there will be the difference when at the time of giving a loan and or at the time of selling? Why the properties are why the properties will have changes? So if at all somebody want to interact or share their views, I think it will be more interactive sessions, so that I think I'm not just going on telling it, so that if at all you want to share something, if at all somebody wants to come here and share their views on, because if at all there will be a lot of difference here and debate with the bankers also, you might have come across. If at all somebody want to share. Murli Garu, I think you might have come across this situation where at the time of giving a loan, and at the time of the selling the property under surfacey or distress selling, there will be a lot of difference in the value. I think nobody. No, okay. Murli garu, Arvinda garu, are you there, madam?
Continue, Andy.
Okay. Okay. So this is another issue where there will be a debate between the bankers and challenge for the professionals like us to justify this figure. So this, I think we need to have a in detailed debate about how we are arriving at these values. So again, valuation as per IVS, International Valuation Standards. Again, if you see the definition of valuation under IVS is also similar to uh, in fact, IBA has taken the definition from International Valuation Standards only. So this is the, so normally we don't in India now we don't have a Indian valuation standard. So in the absence of that, we are all as a valuers we are adopting the international valuation, the best practices, the international valuation standards for our practice. So whenever we do a valuation, we are all bound by IVS. In fact, we write in our report that all our reports are all compliant with the international valuation standard. So the definition, if you see, it is also same. The estimated amount for the property which should be exchanged between the willing buyer and the willing seller. It's like a similar definition like what I told you been adopted by the IBA also. So here also, this is the market value definition as per IVS. Again, if you see the definition as per the IVS, the liquidation value is amount which would realize when an asset or group of asset is sold on a piecemeal basis. Here, they say that the asset has to be sold in a piecemeal basis. Again, you have to understand what is the understanding of a piecemeal. So so this will be very, very useful for all our professionals like who take up this valuation for insolvency or for surface valuations also. See, they want to maximize the valuation of the debtor or the creditor. See, whenever the asset, if at all, if it is sold in parts. See, there is a big property which is having more than 100 acres. There will be a property which is having abutting to the road of around 1 acre. So the 1 acre property which is facing to the highway will be commanding certainly 4x value than the one property which is on the rear side. So if at all you are able to sell the maximize the value for the property on facing on the road than the property which is far interior, then the property you can fetch a good value. And this also may be a case in case of a plant and machinery. See, the plant and machinery as a whole, if you sell it, they may not be limited takers. So, but for that, if you have the asset sold in a piecemeal, like if you have a certain section that if at all a power plant is there, only turbines are being removed, and that has been sold in a market. So that can be fetching a higher value than as a plant as a whole. So that is what you mean to say the definition of the sold in a piecemeal basis. The liquidation value to take into account the cost. So again, while assessing the liquidation value, here also they say that the cost for disposal also should be taken care. The net of the cost, deducting the cost which has to be taken care, that also has to be deducted, and the after deducting the expenses, the net value is what will be estimated or is assessed as the liquidation value. So the definition is very clear, and the IVS, whenever we give a report that our report is as per the complaint of IVS, we should see that we definitely satisfy this definition and give a report accordingly. So the next is the valuation under IBC. If at all for insolvency in bankruptcy board, if you do a valuation for IBC, again the valuations will be as per the requirement. Here, the requirement under IBC is they don't require the market value. In fact, they call it as a fair value. So fair value will be almost equivalent to market value, but they have termed this nomenclature as a fair value. But it is almost similar to the market value, which will be taking care about uh, uh, the premise and the basis of value, like if it is going concern, the highest and best value, highest and best use. So that's called HABU. Highest and best use value should be taken. So, or a synergic value. If at all the property is under the going concern and the property is uh, in working condition, if at all, then sorry, synergic value cannot be taken here. It will be only the market value. Synergic value will be taken for now that if at all the company has come under IBC means there is no synergy. So it has already been come to such a case that there will be no takers for it. They couldn't run the business. That is the reason why they have come for this insolvency IBC, under IBC. So here we will have to assess it as the market value, and they require this liquidation value. So under CIRP, if at all insolvency resolution has to be taken, so they expect two values, the fair value and the liquidation value. Here the liquidation value will be under amount that we realized on the sale of asset or a group of asset when they have already sold. So when they want to terminate the business. So again, here it will be under different circumstances. If it is an orderly liquidation, so or a forced transaction. So we have to give under the both the condition. So as I've told you that orderly liquidation means with the time frame is there to sell the property. And if it is a forced transaction, so that also has to be given in report. So the liquidation value will be very elaborate in giving both the values, like if at all they have been sold in orderly liquidation and a forced transaction. Again, here in IBC, if it is for the companies under liquidation purpose, see, there are two cases under CIRP, under liquidation. Under liquidation regulation 35, if at all the company is under liquidation, the IBC tells you to give a valuation as a realizable value. So the realizable value is nothing but it will be like a liquidation value only after deducting the all the expenses which have to be incurred to for selling the asset. So it will be the net of all the expenses, like the dismantling charges, the selling charges, the whatever the you have to give any brokerage for selling, all that expenses which are incurred to sell the asset will all be part of the expenses has to be deducted, and the net value is what they expect, and that is what they call it as a realizable value under liquidation regulation 35 under IBC. So there are values under IRDA, the Insurance Regulatory Development Authority. They have also come out with a value which they expect. So that is called the reinstatement value. Here there is a difference between the market value and and other definitions. Here it's called reinstatement value. Reinstatement value is what? The asset which has to be now, if at all, it has to be built up in, if suppose a building is there, we have to insure that building. So if at all the building has to be constructed now, as is varies, how much will be the cost to construct that building with the same specification, with the same whatever the specifications and all that, how much will be the cost incurred. So that is called the reinstatement cost. So for that reinstatement cost, if at all you take an insurance for that asset, then this will be helpful for you at the time of whenever the claim of any claims arises. So if at all the asset is on par with the cost as on that day, then you will be not having this under insurance. Otherwise, there will be an under insurance, and you won't get the entire whatever the expense or whatever the loss which you have incurred due to any accidents to that asset. The entire loss may not be recovered by the insurer. So so now the what you have to do as an insurer is you have to uh, insure for the actual cost or the reinstatement value. How much? So every year, the whenever you go for insurance renewal of your insurance policies of the asset, the banker or the anyone who want to take it, so they will require to take it for the reinstatement value. So this valuation also we undertake for all the clients, for the companies, for assets. We do such sort of valuation also for reinstatement purpose. So this is another value which, as a professional, we need to understand the distinction between the market value and the other value, reinstatement value. So for the market here, for any other purposes like mergers and acquisition also, here also the market value is similar to the IVS definition and the IBA definition. It will be all the same between the willing buyer and the willing seller, between the arm's length transaction with proper marketing. It says the same thing. So that is what they will expect during a merger. So the premise of the value should be here the synergic value and the highest and best use value. So here normally why the mergers and acquisitions happen? Because there is another synergy between the other company which they want to take over. So that is when they want to have the highest value of the asset. So that then the merger or acquisition can happen. So here the value of synergic value will be more relevant. So the base and the premise of the valuation should be important here while doing such mergers and acquisition. So again, there are other basis of valuations which required by the companies: assets on a standalone basis, assets on a slump sale, assets in a parcel, or so normally what happens under insolvency and bankruptcy, IBC, the CIRP, sometimes the resolution professional will be asking the registered valuer to give the valuation under different scenarios. The assets under standalone basis, assets under slump sale. So standalone basis means as is varies. If at all you have to sell the asset, so what will be the value? See, in this all these thing, the assets under the slump sale will be the least one. So assets in the slump sale means, I think they don't want to attribute certain values to each and every asset. So they say in lump. So in a lump, how much will be the entire value of the asset? So they don't go individually asset wise. So in that case, what will happen? The value will be on the least of these five. The slump sale asset valuation, if at all you do it, that will be the least. The assets in if at all you sell it in a parcel. So again, the reason of asking all these valuations is under the IBC, the maximization of value for the corporate debtor. So here our concern as a registered valuer, we should see that how we maximize the value. See, it's not the question of just giving a value. So how at all for if at all you sell the assets in as a going concern, whether the value you are able to maximize the value for the corporate debtor, or if you sell the assets on a going concern basis. So going concern basis here means as it is if the company is able to run the business and certain other new investor or the person who wants to take over that asset comes into that, steps into the shoes of the existing corporate debtor and runs the business. If at all he is able to do that, whether that is the maximization will happen, or if at all that corporate debtor has to be removed and again the business of the corporate debtor will be taken over by some other person, or the assets will be, if at all you sell the assets in entirety in a collective basis. See, some assets maybe will be yielding a less value. Some assets will be yielding a higher value. So we, as a registered valuer under CIRP or under liquidation, we have to see that how we maximize the valuation. So these are the other five areas under which the resolution professional also expects the registered valuer to give a valuation in for the company's purpose. So I think this I have come to end of this thing. If at all we have something we can interact. Murli garu, I was just asking.
Yes, sir. Yes, sir. Any questions?
If at all we can discuss something or if we want to share something, I think this is the best platform. We all the professionals are there at as one go. If at all somebody wants to share and add, will be very helpful and please. So I thank each and one for being part of this one. Thank you, Murli garu, for giving this opportunity.
Thank you, sir. Thank you, sir. Sir, just I will brief you, sir, regarding the Hyderabad CS. This is a new company formed. The up to last president acted as the Prabhuna Kumar up to last year, and now Lakshmi Reddy is the president, and myself is the vice president, and Arvind Garikapati is the secretary, and Kedarnath is the treasurer, and Ravi Teja is the Ravi Teja and Ankita and Vinod, Badrinath, Rajesh Jain, Praveen Kumar, Praveen, and all other members are the new committee members, sir. We are trying every second and fourth Saturday morning 8 to 10 some knowledge sharing on each topic on second and fourth Saturday. I think Lakshmi is available, President, and Arvind Madam. Any other member?
Antika is there.
Madam,
Antika
Secretary,
is the
good
committee
morning.
member.
Yes, madam. So, any other questions and sessions is there? And
I think this is the best platform. We all professionals coming like this from different fraternity and sharing the knowledge. This itself is I think a good start. Hoping to look forward to have a few more interactive sessions with all you people.
It will be a pleasure.
Hi, sir. Sir, this is Badrinath.
Yes, sir.
Hi, sir. Sir, actually, when a bank wants to give a loan to any company and they want to take any security of any person as a collateral,
Yes.
first majority of the banks will try to make sure that that person is a director at least or has some certain stake. But I have seen few banks where they are disbursing the loan to a company, even if he's not a shareholder or a director, just by taking collateral of that person. Is that practice is something that is common or is very rare? So just want to compare.
Madhugaru, can you add or shall I just actually Madhugaru?
Yeah, and yes, sir.
Yes.
Yeah, I think it is not. I think it's not regular. It's not a regular case. Maybe rare cases it may happen. I think
Okay.
whenever banks accept any collateral security, he has to be one of the director of the company. I think unless and until I think even nowadays third parties collateral securities banks are not accepting. I think is it,
Yes, very true. That's what I want to add. See,
Mhm.
third party security, the last security which the bank or financier accepts. See, they will definitely write a condition in the sanction letter that tomorrow he has to be part of the board. So that the bank will expect. The reason for today's the CVC, if you see, vigilance and all that, they have been stringent and they want all the directors to be part of that company. See, because of all these NPAs happening, so they have been making this mandatory to see that the security is offered by the person is not again in a third party. He should be part of the company.
Okay, secondly, basically, the example that I had taken when I went into the case, it is actually an NBFC. It is not a proper bank, it is an NBFC. So is there any exception for NBFCs or still they will be guided by an RBI guidelines only, right?
Very true, sir. But in certain NBFCs, they are getting this slightly liberal than the other PSU or the private bank. That is the reason why now the stringent norms are also coming up after the collapse of ILFS and all that. They have also started doing that. Again, the third party securities are taking very minimal or again company to company, the business to business and all that. But very rarity I have come across in NBFCs also of late they have also made it a mandatory that it should be part of the director's properties or only that will be taken.
Yeah, perfect, sir. Sir, one more. I don't think there is a rule where he has to be a shareholder. As long as he's a director, that should be fine, right?
Yes.
Okay.
So for income tax purpose,
Yes.
why they are asking for merchant bankers validation? Any reason, sir?
For merchant bank means like for the shares.
Any other SFA valuation, we are doing a valuation, no, sir. For all class of assets, IBBA registered valuer they are doing, but income tax they will not consider for IBBA registered valuer. They are asking for the merchant banker valuation.
Again, they wanted to make it a niche area where every registered valuer is not a merchant banker. Again, that has been made into a certain segments. Only few.
Capital is required for merchant banker. Why that variance they brought it? There is some logic in it. Okay.
I am not aware, sir. I'm sorry.
Sir, one more.
Yes, sir.
Sorry. Can I go ahead, sir?
Yes, sir. Badri, go ahead.
Yeah. So actually, I have seen some companies where there will be certain properties which will be held by a strike of companies. So when we get into the rules of the Companies Act, technically, once a company becomes a stuck-off entity, all the properties of such entity becomes the property of the government until and unless you revive the company. So there is a rule that I had read it, okay, but I just need to dig it. So once it becomes a property of the government again, to get that properties again back, so they have to revive the property by going to NCLT and they have to activate that company. So when valuation mechanism is done, so what I see is the valuers are not looking at this aspect because it is a title lapse. When the law says that when our company had purchased a property which is owned by a strike of company. So ideally, that the other company do not have a right because it's already when the ownership has gone to the government and we bought it. So there is a title lapse. But I see that valuers are not really looking into lawyers in legal opinion. Nothing is being commented. So have you come across any of that sort, sir, by any chance?
Murali can comment on it. He is the one who is dealing with NCLT. Murali Garu?
Yes, sir. Even I am not perfect on that solution, sir.
Okay, sir. Okay.
I think it should
Generally,
be like a
once
corporate
a
legal matter should be, I think.
once a strike-off is there, generally we will apply for the reversal of the strike-off from the NCLT. But valid assets will not take by the government based on my knowledge.
Correct.
Once a company is strike off, it is not possible to transfer the company property to any other person, sir.
In the register office, there is no such check, sir. ROC is not, register is not checking whether the property is owned by that strike off company. So when we even check it, so the property is getting sold.
Okay.
Valuation is getting recorded. Registration, sale is getting registered.
Okay.
Yeah, but when it comes to the role of the valuer and the legalities, I think we never check the legalities.
Perfect. Yeah. My question is correct. You're right.
Yeah.
Lawyers, legal opinion, they have to comment on it.
Yeah, we will check the whether this property is I think market value only our scope of limit, and there we will I think our scope will be limited only in the particular area. And generally, whenever we issue any reports, and we will check whether this land is belongs to government or belongs to any legal issues are there, that we will cross verify and we will write our comments on the report. That is what we will do, but we will not comment like whether it is can be acquired or whether it is can be reversible or not. That point we will not never touch on the reports.
Okay.
I'm Venkateswara here. Coming to the question of Mr. Badrinath regarding merchant banker valuation, because the act itself is stipulating if any discounted cash flow is being followed, so merchant banker has to do the valuation. Otherwise, if it is NAV, any chartered account can do. But registered value, there is no role in the valuation as far as income tax is concerned.
Yes, sir. Maybe yeah, true.
Am I clear?
Yes, sir.
Yeah.
Any other questions from the members?
I think such sort of interaction sessions, if at all we can have with all you professionals, I think the more and more, I think we can discuss more on case studies also. I think next to Murali Garu, we can have other sessions, because this we have not, at the last 11th hour, we got to know about this session. But going forward, I suggest that we'll have more of interesting case studies we have come across, so that can be useful for professionals, and we can exchange our views and ideas, and that can be helpful for our professional career.
Thank you, say thanks to Madhugar and you, because only yesterday evening 5 o'clock I informed, and without rejecting, accepted for both the people, and all the members also. Thanks for joining. Arvinda.
Sir.
Madam, Arvinda Madam is the secretary. Madam, you take a charge. And any other member want to discuss any
questions which can be
otherwise will
to be answered?
And sir, whatever is suggested, practical scenario also we'll try to conduct, madam. Next time, whenever is possible, we'll conduct the case laws also based on the members and all the members. Right?
Yeah, Murali, I think if you have any specific topics also, you can come back, just share it to us, and we will prepare some, because we have a good faculty in institution and Hyderabad chapter. So that definitely we will, if you need any specific topics also, you can just come back to us, and so that we will give you some, wherever possible, we will support.
Sure. Thank you, sir. Arvinda, take a charge.
So can I present the vote of thanks?
Yes,
Any
madam, go
question?
ahead, madam. If there is no questions, means we'll go ahead.
Any members has any questions? Thank you. The HCS would like to extend the heartfelt gratitude to our esteemed speakers, Mr. Madhu Garu and G.V. Apparao Garu, for the graciously accepting our invitation on such a thankful for it and thank you for your willingness to share your expertise and insights, which will help us a brief note on the brief short notice is a truly commendable and greatly appreciated activity. Once again, thank you for your willingness to step in the last hour and share your knowledge with us. We thank you on behalf of HCAS.
Thank you, madam.
Thank you, sir.
Thank you very much, madam. Thank you, Murali garu. Thank you, madam.
Thank you, sir. Thank you, everyone, for joining.
Good day.
Yeah, thank you all, sir, for great session. Thank you.
Have a nice day, sir.